Morning everyone. Today we want to discuss about analysis and interpretation of financial statements of Company A. Assignment, we analyze the financial performance of Company A and compare it with Company B as a benchmark. Company A was founded in 1974 and is a property development company listed on Bursa Malaysia. It is involved in residential, commercial, industrial and township projects. The company also operates in Australia, Vietnam, Singapore and UK. Company B is a well-known integrated developer with a diversified business. Because of this, Company B has more stable income compared to Company A. This study looks at Company A's financial performance from 2020 to 2024 and compare it with Company B from 2023 and 2024 to understand Company A's strengths and weakness. I will explain the methodology we use. In this assignment, we use quantitative financial analysis approach based entirely on secondary data from the company's annual reports. Company A's annual reports from 2020 to 2024 and Company B's annual reports from 2023 and 2024. The key financial statements used include the statement of financial position, statement of profit or loss, and statement of cash flows. Financial performance was evaluated using financial ratio analysis grouped into 4 categories. First, profitability ratios, including net profit margin and return on equity. Secondly, liquidity ratios, including current ratios and quick ratio. Thirdly, efficiency ratio, including asset turnover ratio and inventory days. And lastly, capital structure ratios, including debt to equity ratio and interest coverage ratio. All ratios were calculated using consistent formulas and data extracted directly from the annual report, ensuring accuracy and comparability between the both companies.
For this slide, I will discuss the evaluation of Company A. Firstly, in terms of strengths, Company A shows a clear recovery trajectory. After the downturn in 2020, the company has demonstrated a noticeable improvement, particularly in its profitability ratios, which have returned to positive levels. This indicates that Company A is gradually stabilizing and recovering from earlier financial challenges. Secondly, Company A has enhanced its financial stability. The company has improved its liquidity position and adopted a more conservative capital structure, which reduces financial risks and strengthens its overall financial position. Thirdly, Company A has shown operational improvements. The increase in asset turnover and improvement in inventory management suggest better operational efficiency and project execution. However, compared to Company B, there are still some weaknesses. Despite the improvements, Company A continues to face operational inefficiencies, especially in terms of longer inventory cycle. These longer inventory period tie up capital and increase exposure to market fluctuation. In summary, although Company A has made strong internal progress, its overall efficiency and competitiveness remains lower when compared to Company B. This slide presents the strategic recommendation for Company A to improve its performance in the future. Firstly, Company A should focus on enhancing profitability and shareholder returns. This can be achieved by prioritizing high margin and fast turnover projects to improve overall profit margins. Secondly, Company A should adopt a data-driven planning approach. By investing in advanced analytics and demand forecasting, the company can better align construction activities with market demand, helping to reduce excess inventory. Thirdly, in terms of strategic financing, Company A should consider using fixed rate or longer-term debt. This would allow the company to secure favorable borrowing costs and improve predictability in financial planning. Lastly, Company A should diversify its revenue stream, expanding into commercial and investment properties such as offices and retail spaces can provide more stable rental income and reduce reliance on cyclical property development revenue. Overall, these strategies aim to strengthen Company A's financial position, reducing risk and enhance long-term sustainability.
Good day everyone. In this section, I will explain the calculation of key financial ratios over a 5 years period from 2020 to 2024. The calculations are grouped into profitability, liquidity, efficiency, and capital structure ratios, using figures obtained directly from the annual financial statements. Profitability ratio calculations are the first. So, profitability ratio were calculated using net profit margin and return on equity. Net profit margin is calculated by dividing net profit after tax by total revenue and multiplying the result by 100. Using this formula, the net profit margin was negative 7.57 in 2020, increased to 9.23% in 2021, slightly declined to 8.61% in 2022, and 8.17% in 2023, before rising significantly to 11.91% in 2024. Return on equity is calculated by dividing net profit after tax by total equity, multiplied by 100. Based on this calculation, ROE increased from negative 1.59% in 2020 to 2.22% in 2021, 2.27% in 2022, 2.28% in 2023, and reached 3.98% in 2024. Liquidity ratios calculation is number 2. So liquidity ratios were calculated using the current ratio and quick ratio. So the current ratio is calculated by dividing current asset by current liabilities. The calculated current ratio were 2.18 in 2020, 1.98 in 2021, 1.48 in 2022, 1.68 in 2023, and 1.8 in 2024. The quick ratio is calculated by subtracting inventories from current asset and dividing the result by current liabilities. Using this formula, the quick ratio declined from 1.35 in 2020 to 1.2 in 2021, fell below 1 to 0.9 in 2022, then recovered to 0.93 in 2023 and 0.01 in 2024. Next is efficiency ratios calculations. So, for efficiencies, two ratios were calculated: asset turnover ratio and inventory days. The asset turnover ratio is calculated by dividing revenue by total assets. The result increased steadily from 0.106 in 2020 to 1.21 in 2021, 1.149 in 2022, 1.151 in 2023, and 1.192 in 2024. Inventory days is calculated by dividing inventory by cost of sale, then multiplying by 365 days. Based on this calculation, inventory days reduced from approximately 605 days in 2020 to 541 days in 2021, 437 days in 2022, 515 days in 2023, and 394 days in 2024. Capital structure ratio calculations is the last. So, lastly, capital structure ratio were calculated using debt to equity ratio and interest coverage ratio. The debt to equity ratio is calculated by dividing total liabilities by total equity. This ratio declined from 1.51 in 2020 to 0.99 in 2021, 0.94 in 2022, 0.85 in 2023, and 0.74 in 2024. The interest coverage ratio is calculated by dividing earnings before interest and tax by finance cost. The result improved over time, reaching 3.92 times in 2024, indicating stronger ability to cover interest expenses. In summary, these calculations provide the quantitative basis for evaluating the company's financial performance over the 5 years period and form the foundation for the analysis and interpretations discussed in the next section. So next, I will focus on the 5 years financial ratio analysis from 2020 to 2024, covering profitability, liquidity, efficiency, and capital structure. So the analysis is based on data extracted from the company's annual financial statements. Profitability ratio are the first one. So let's look at it. Let us look at the profitability measure using net profit margin and return on equity. So between 2020 and 2023, the net profit margin remained relatively constrained, fluctuating within the range of approximately 8% to 9%, reflecting a gradual recovery following the downturn in 2020. However, in 2024, the net profit margin increased significantly to 11.91%, indicating improved cost efficiency and stronger operational performance. Similarly, return on equity (ROE) showed a steady upward trend. From 2021 to 2023, ROE averaged around 2% to 2.5% before rising sharply to 3.98% in 2024. Although this improvement reflects better utilization of shareholders' equity, the overall ROE level remains relatively low, suggesting room for further enhancement in profitability efficiency. Next is liquidity ratios. So the liquidity position is assessed using the current ratio and quick ratio. Throughout the 5 years period, the current ratio consistently exceeds the quick ratio, indicating that inventories form a significant portion of current asset. The weakest liquidity position was observed in 2022, where the current ratio declined to 1.48 and the quick ratio fell below 1 at 0.9, signaling potential short-term liquidity pressure. However, improvements were recorded in 2023 and 2024, with the quick ratio recovering from 0.01 in 2024, suggesting an improved ability to meet short-term obligations without relying heavily on inventory liquidations. Next is efficiency ratios. So moving on to efficiency ratios, evaluate using the asset turnover ratio and inventory days. The asset turnover ratio increased steadily from 0.106 in 2020 to 0.192 in 2024, indicating improved efficiency in utilizing assets to generate revenue. At the same time, inventory days decreased significantly from over 600 days in 2020 to approximately 394 days in 2024. This reduction reflects improved inventory management and faster project turnover, which contribute positively to cash flow. And finally is capital structure ratios. The capital structure is analyzed using the debt to equity ratio and interest coverage ratio. The debt to equity ratio declined consistently from 1.51 in 2020 to 0.74 in 2024, indicating a shift toward a more conservative financing strategy with reduced reliance on debt. In addition, the interest coverage ratio improved to 3.92 times in 2024, suggesting stronger earning capacity to service interest obligations. So in conclusion, the 5 years ratio analysis indicates a clear recovery and strengthening financial position, particularly in terms of operational efficiencies, liquidity improvements, and capital structure stability. While profitability has improved further, enhancements are required to maximize the return to shareholders.
Okay, now let's begin our comparison by looking at profitability between Company A versus Company B. Company A improved its net profit margin to 11.9%, but Company B started higher and reached 16.3%. More importantly, look at ROE. Company B delivers an 8% return to shareholders, double that Company A's 4%. This tells us Company B is fundamentally better at turning investor capital into profit. Now, next slide. Profitability analysis. What does this gap mean? For Company A, the improvement is a positive sign of recovery. However, its lower ROE suggests its equity base isn't working as hard. In contrast, Company B's diversified model, with steady income from non-property segments, supports higher margins and stronger returns. Now, next slide. Liquidity ratios. Now, let's examine the short-term financial health In 2023, Company A's quick ratio was below 1, meaning about selling properties, covering short-term debts could be tight, while Company B started with a stronger position in liquid assets. Now, next slide, liquidity analysis. The chart makes the story clear. Company A improved its quick ratio to just above 1 by 2024, a positive step, but its liquidity remains tied to property sales. Company B's quick ratio, while easing slightly, reflects a business model that generates cash from diverse operations, offering a different kind of financial resilience. Now, moving on to the next slide. Operational efficiency, also known as efficiency ratios. We see the most significant competitive gap. Company B's asset turnover is higher, meaning it generates more sales from assets. But the real standout is inventory days. Company B turns inventory in 130 days, while Company A, despite improvement, takes 394 days. Next slide. Alright, let's visualize this. In this efficiency analysis, both companies are improving asset turnover, but Company B is consistently higher. Now, look at inventory days. This isn't a small gap. It's 264 days. That means Company B capital is freed up almost 3 times faster, a massive advantage in cash flow and risk reduction. Now, next slide. Capital structure ratios. Next, how are these companies financed? Company A reduced its debt-to-equity ratio to 0.74, showing a conservative approach. Company B increased leverage to 0.98, but the key is interest coverage. Company B's earnings cover interest costs over 5 times, making its debt strategic, not risky. Now let's move on to the next slide, capital structure analysis. The trend tells 2 stories. Company A is de-risking, lowering debt for stability, while Company B is leveraging up to grow. Backed by exceptionally strong earnings, both strategies are rational, but Company B's higher interest coverage gives it more room to maneuver. Now let's move on to the next slide. A direct comparison now between profitability. Bringing profitability together visually, the verdict is clear. Company B is more profitable. Its net margin is about 4.3 higher, and its ROE is about 4.1% higher. Company B simply generates more profit per ringgit of sales and per ringgit of equity. Now let's move on to the next slide. A direct comparison of liquidity. On liquidity, it's a tie with different strengths. Company A has stronger current ratio, more asset buffer essentially, while Company B has historically had stronger immediate liquidity from operations. Both are resilient, but in different ways. Now moving on to the next slide. A direct comparison on efficiency. On efficiency, Company B is significantly ahead. Its assets generate about 30% of revenue, and its inventory turns over 264 days faster. This operational accelerance is a core competitive advantage. Now let's move on to the last slide from me, a direct comparison of capital structure. Finally, capital structure. Company A is conservative, building a safety buffer, while Company B is growth-oriented, using debt confidently thanks to growing earnings. Both strategies work, but they reflect different risk appetites.
In conclusion, we found that Company A has shown a clear financial recovery since 2020 with improvements in profitability, efficiency, liquidity and capital structure over the 5-year period. However, when compared to Company B, Company A still lags behind in profitability and operational efficiency, particularly in inventory turnover and asset utilization. Company B's diversified operations provide stronger recurring income and higher financial performance. Therefore, while Company A has strengthened its financial stability, it must focus on improving operational efficiency and accelerating inventory turnover and expanding recurring income streams to remain competitive and enhance long-term shareholder value. That's all from us. Thank you.